Welcome to the Veridion Briefing. I am Sloan Mercer with the Veridion Group, a private intelligence and security consultancy. This is a special edition, and today we are going to explain something that most people, including most people in corporate security and financial compliance, do not fully understand. How illicit money actually moves in 2026. Not in theory, not in a textbook compliance diagram, in practice. How terrorist organizations fund operations. How sanctioned states move billions of dollars around enforcement mechanisms. How drug cartels launder proceeds across borders. And how all of these different threat actors are increasingly converging on the same financial infrastructure. That infrastructure is the fusion of two systems. The first is the ancient one, underground banking, Hawala networks, informal value transfer systems where trusted brokers move money across borders through mutual obligation rather than wire transfers. This system has existed for centuries, and it works because it is built on personal trust, not institutional compliance. The second is the modern one. Cryptocurrency, specifically stablecoins, digital assets pegged to fiat currencies that provide the low volatility and high liquidity that brokers need for reliable settlement. The merger of these two systems has created what our analysts call the Crypto-Hawala model, and it is now the dominant infrastructure for moving illicit money at scale across virtually every major threat category: terrorist financing, sanctions evasion, narcotics laundering, human trafficking, and migrant smuggling. All of them are running through the same pipes. Let me explain how the model actually works, because the mechanics matter more than the buzzwords. Start with a local broker. This person might operate a money services business, a currency exchange shop, an over-the-counter trading desk, or simply a trusted individual within a community network. A customer brings them cash or fiat currency. The broker records an obligation, not to a bank, but to a counterpart broker in another country. No wire transfer is sent, no SWIFT message is generated. The obligation exists on an internal ledger maintained through a trust relationship between the two brokers. Over the course of a day or a week, multiple customers bring money to the local broker, and multiple customers on the other end receive money from the counterpart broker. These individual transactions are netted against each other on the internal ledger. At the end of the settlement period, only the net balance needs to move between the two brokers. Here is where cryptocurrency enters the picture. That net balance is settled via cryptocurrency transfer between broker-controlled wallets. The preferred instrument is stablecoins because the brokers need the value to remain constant between the time they send it and the time it arrives. Bitcoin is too volatile for this purpose. A stablecoin pegged to the US dollar holds its value, settles in minutes, crosses borders without correspondent banking relationships, and leaves a blockchain trail that is visible but can be obscured through layering techniques. The layering phase is where the sophistication increases. Brokers use over-the-counter desks to convert between currencies and assets. They use nested service arrangements where an unlicensed operation piggybacks inside a larger, ostensibly compliant exchange. They use peel chains, where a single large transfer is progressively stripped across dozens of wallet hops, each removing a small amount until the original sum is dispersed across many endpoints. They chain hop across different blockchains to complicate tracing. And they interact with mixing services, automated tools that blend cryptocurrency from multiple sources to obscure the origin. This is not theoretical. This is the operational model described across multiple U.S. government enforcement actions, financial crimes enforcement network advisories, and United Nations reporting. And the scale is staggering. Analytics reporting from TRM Labs indicates that illicit cryptocurrency volume reached a record high of approximately $158 billion in 2025. That is not a typo. $158 billion. That figure reversed a multi-year decline and reflects intensified exploitation of crypto rails by sanctions-evasion ecosystems and organized crime networks. Some of that increase reflects improved detection and attribution capabilities by analytics firms, but the trend is real, and stablecoins are at the center of it. TRM Labs reporting identifies stablecoin usage as central to illicit crypto flows and highlights that sanctions-related activity in 2025 was overwhelmingly driven by Russia-linked stablecoin transactions. Specifically, a ruble-pegged stablecoin called A7A5 processed more than $72 billion in total volume. I will come back to that story in a moment because it is one of the most instructive cases in modern sanctions evasion. First, let me walk through the terrorist financing picture because it is both real and more nuanced than most people understand. Our assessment, based on FinCEN alerts and advisories addressing Hamas, Palestinian Islamic Jihad, ISIS, and Iran-backed militant organizations, is that terrorist financing use of cryptocurrency is real but primarily facilitation-centric. What does that mean? It means crypto is not primarily being used for large-scale retail donation campaigns where supporters send Bitcoin to a published wallet address. That happens, but it is not the main vector. The primary vector is the broker infrastructure I just described. Exchange nodes, money services businesses, over-the-counter desks, and Hawala networks that use cryptocurrency as a settlement layer within their existing operations. The most concrete evidence comes from U.S. government enforcement actions targeting Gaza-based networks. In October 2023, the Treasury Department's Office of Foreign Assets Control designated a Gaza-based virtual currency exchange and money services business called Buy Cash Money and Money Transfer Company, along with its operator, as part of actions targeting Hamas financial facilitators. That is not an allegation. That is a formal U.S. government designation with the force of law behind it. In January 2024, OFAC went further. It targeted additional Hamas-affiliated financial exchanges in Gaza and explicitly described cryptocurrency transfers from the Islamic Revolutionary Guard Corps Quds Force to Hamas and Palestinian Islamic Jihad through these nodes. Read that again. The U.S. government formally documented a pathway where Iran's military intelligence arm, the IRGC Quds Force, transferred cryptocurrency through Gaza-based exchange nodes to fund Hamas and PIJ. That is a state-sponsored terrorist financing pipeline with cryptocurrency as a core component. For ISIS, FinCEN's April 2025 advisory outlines financing typologies where Hawala and money services business patterns remain central. The advisory does not specifically detail cryptocurrency settlement within ISIS Hawala networks, but given the demonstrated convergence of underground banking and crypto rails across every other threat actor set, it would be analytically unsound to assume ISIS networks are not exploiting the same infrastructure. For the broader Iran-backed militant ecosystem, FinCEN's May 2024 advisory provides the single strongest framework for understanding how traditional underground banking networks serving Iranian state-sponsored groups integrate cryptocurrency settlement without requiring a complete restructuring of their existing financial operations. The key insight is that these groups did not need to build new infrastructure. They adapted existing infrastructure. The Hawala network was already there. The trust relationships were already there. Cryptocurrency simply became the settlement instrument that replaced physical cash couriers or gold transfers for cross-border balance settlement. Now, let me tell you the Garantex story because it illustrates how resilient these systems are and why enforcement alone cannot solve the problem. Garantex was a cryptocurrency exchange that became one of the most significant facilitators of sanctions, evasion, and cybercriminal activity in the world. It was sanctioned. It was disrupted by law enforcement in March 2025, and within weeks it was back. The employees of Garantex created a successor exchange called Garantex and rebuilt the infrastructure to continue providing services to their customer base almost immediately after the enforcement disruption. OFAC designated Garantex in August 2025, formally documenting that it was created by Garantex employees specifically to continue the sanctioned entity's operations. The mechanism they used to transfer customer deposits from the old platform to the new one was the A7A5 stablecoin I mentioned earlier. That stablecoin was issued by a Kyrgyzstani firm called Old Vector and created for Russian customers of a cross-border settlement platform owned by a sanctioned Moldovan oligarch named Ilan Shor and connected to sanctioned Russian bank Pромsvязьbank. Follow the chain. A sanctioned exchange gets shut down. Its employees create a successor exchange. A purpose-built stablecoin issued from a third country transfers customer deposits from the old exchange to the new one. The stablecoin is connected to a sanctioned oligarch and a sanctioned bank. The entire apparatus reconstitutes itself in weeks. This is not an anomaly. This is the operational model for how sanctioned financial infrastructure survives enforcement actions in 2026. And the $72 billion that flowed through the A7A5 stablecoin tells you the scale at which this model operates. The convergence extends beyond terrorism and sanctions evasion. The United Nations Office on Drugs and Crime documented in its 2024 reporting that underground banking is a critical enabler for transnational organized crime across East and Southeast Asia, with cryptocurrency increasingly embedded alongside casino, junket, and traditional broker ecosystems. Think about that combination. Casinos provide cash-intensive environments ideal for layering. Junket operators move high-net-worth gambling clients and their money across borders. Underground bankers settle the cross-border obligations, and cryptocurrency provides the digital rail that connects all of it. FinCEN's August 2025 advisory on Chinese money laundering networks linked to Mexico-based transnational criminal organizations describes the same convergence from a different angle. Broker networks facilitating cartel proceeds laundering are using layering methods that leverage crypto settlement alongside traditional trade-based money laundering and underground banking. The cartels do not care whether the settlement instrument is cryptocurrency, trade invoices, or gold. They care that it works. And the Crypto-Hawala model works. This brings us to a critical analytical question. How central is cryptocurrency to terrorist financing specifically relative to these other illicit markets? Our analysts evaluated three competing hypotheses. Hypothesis 1 is that Crypto-Hawala is a primary global driver of terrorist financing. We do not assess this as well supported. The data shows that terrorist financing volumes, while real, do not dominate the illicit crypto landscape. Sanctions evasion and organized crime flows are vastly larger. Hypothesis 3 is that Crypto-Hawala is marginal to terrorist financing and traditional methods still dominate with crypto adding negligible capability. This hypothesis is inconsistent with the OFAC designations I just described. When the U.S. government formally documents cryptocurrency transfers from the IRGC Quds Force to Hamas through designated exchange nodes, you cannot credibly argue that crypto is irrelevant to terrorist financing. Hypothesis 2, which our analysts assess as most consistent with available evidence, is that Crypto-Hawala is important but unevenly distributed across terrorist financing. Larger volumes flow through sanctions evasion and organized crime channels. Terrorist financing actors share the same facilitation infrastructure with these broader illicit networks rather than maintaining separate dedicated crypto pipelines. The terrorists are not building their own financial systems. They are plugging into systems that already exist to serve much larger criminal markets. This has a direct practical implication. If you are trying to disrupt terrorist financing through crypto, you cannot do it by looking only at terrorism. You have to understand the entire illicit financial ecosystem because the infrastructure is shared. Now, what about banks? This is a question that matters enormously for financial institutions and compliance teams, and the answer requires precision. Our assessment is that the role of mainstream banks in Crypto-Hawala networks is most accurately characterized as exposure rather than complicity. Banks are unknowingly processing on-ramp and off-ramp transactions where customers convert between fiat currency and cryptocurrency. They are serving as correspondent banking channels affected by nested money services, business behavior, where an unlicensed operator piggybacks inside a licensed entity. And they are functioning as detection and reporting nodes through suspicious activity report filings. This characterization is not our invention. It comes directly from FinCEN advisories, which consistently describe banks as detection points rather than co-conspirators, absent specific enforcement documentation naming a bank as complicit. The most defensible attribution of corporate involvement centers on designated virtual asset service providers, money services businesses, and exchange front companies, not mainstream banking institutions. We apply a conservative standard that limits named entity inclusion to organizations explicitly identified in official enforcement actions, because naming entities as involved without that documentation carries unacceptable false attribution risk. That said, exposure is not the same as safety. A bank that unknowingly processes transactions connected to a designated entity or a sanctioned exchange successor faces regulatory risk, reputational risk, and potential enforcement consequences. The compliance challenge is detecting the signatures of this activity within transaction flows that appear on the surface like routine commercial activity. The indicators our analysts monitor include many-to-one cash intake behavior through money services business or over-the-counter fronts, paired with periodic batched cryptocurrency settlements to repeating counterparty wallet clusters. Rapid interaction with known or suspected mixing services, followed by fiat off-ramp attempts through compliant exchanges. And exposure to OFAC-designated exchanges and their successor entities, particularly wallet addresses associated with the Garantex, Grinex, and A7A5 ecosystem and Gaza-based designated exchange networks. For financial institutions, the takeaway is that your transaction monitoring systems need to be calibrated not just for traditional wire transfer-based money laundering, but for the hybrid crypto-fiat patterns that define the modern illicit finance landscape. The Crypto-Hawala model does not replace the banking system. It uses the banking system at specific touchpoints, the on-ramps and off-ramps, while conducting the core value transfer outside of it. Your exposure is at those touchpoints. For corporate security and risk professionals more broadly, the takeaway is that the financial infrastructure supporting terrorism, sanctions-evasion, and organized crime is converging. The same broker networks, the same stablecoin settlement rails, the same obfuscation techniques serve multiple threat actor sets simultaneously. Understanding that convergence is essential for accurate threat modeling, whether your concern is terrorism risk to overseas operations, sanctions compliance for your supply chain, or fraud and financial crime exposure within your business. The bottom line is this: the informal value transfer systems that have existed for centuries have fused with the cryptocurrency rails that emerged in the last decade. That fusion has created a financial infrastructure that is fast, global, resilient to enforcement disruption, and shared across every major category of illicit finance. $158 billion flowed through it in 2025. The trajectory is upward. The actors exploiting it range from state intelligence services to street-level drug networks. And the enforcement community, despite significant actions against Garantex, Buy Cash Money, and other designated entities, is engaged in a structural race against infrastructure that reconstitutes faster than it can be dismantled. That is the Veridion Briefing Special Edition on cryptocurrency-based illicit finance. The full analytical product with complete source citations, enforcement action documentation, the competing hypotheses matrix, indicator lists, and source reliability ratings is available through the Veridion Group. If your organization needs to understand how these illicit financial networks affect your compliance posture, your supply chain risk, or your operational security, visit veridiongroup.com/briefing to schedule a consultation with our analysts. I am Sloan Mercer with the Veridion Group. Stay informed, stay prepared. I will see you next week.